Now, before we get started, we'd like to remind you, please like, share, subscribe. We love to hear from you. Leave some comments. If you have any feedback, things that you'd like to see, those are always appreciated. And as a reminder, we do have our end of year report available. Just reach out to learn more. So this is a good way to kind of transition between where we sat in terms of small businesses, large corporations, and this is the deal number. Now, this is a mixture of initial public offerings, IPOs, and secondaries that have come through, and they've just shattered records in 2020. As you can see, as guys have looked to hit the tape in order to take advantage of some of these elevated stock prices. And it's a mixture of two different things. One, we've had a lot of IPOs come in because everything, valuations have been white hot. If you lose money or don't make money, now's the time to issue because your stock will increase 300% within the first week. So this is something where obviously deals have come through. And then at the same time, in order to bridge that gap to hopefully get to the other side, we're getting more and more individuals looking to issue secondaries. And I mean, given just the level, we're getting at the money secondaries because the people are buying down the new issuance very quickly. And then we've also seen M&A starting to kick up with all stock deals, which again is seeing a lot of this movement as people are using stock as currency, just given the very, very healthy valuations that we continue to see in the market. Now, this is a stock courtesy of Matthew Water. He was kind enough to just do the S&P 500 futures versus the US dollar or DXY index inverted. And you can see that as the dollar has fallen, the S&P futures have gone up. Now, it's interesting because every single time the dollar just kind of pauses or rallies, the S&P doesn't fall, it just kind of flatlines. And then as the dollar continues its decline, it gets this rejuvenation, it just explodes to the upside. Like right now, the dollar is essentially down, the index is down about 20 cents or so. So it hasn't really done much, but yet we've had the market continue to shift higher, being up about 17 handles or so as we continue to see some of these impacts. But again, it's been a very much a dollar-driven show where as the dollar goes down, everything goes up. And but even though it's creating this, it's again, there's a backdrop between what is activity. Like right now, miles traveled on U.S. interstates was down 4% last week. So we're continuing to see, less people doing less, but trucking miles were up 10% year over year. So again, as we talked about in the EIA show, specifically in segment 2, trucking continues to drive higher, but people aren't going on the road as much. Now, obviously, this will adjust with people going on the road for Christmas, but it just won't be to the same level. Again, looks to a lot of the problems that we continue to see, but people are issuing bonds. So I found this chart. It was on the Daily Shot. I always use IIF data. It's very good. And this sent me down a rabbit hole because I didn't know what I've heard about social bonds, but I didn't really understand what a social bond was. And here you can see from 2019 to 2020. 2019 there was about $10 billion worth of social bonds issued, and so far we're at about 110 billion. And it's bonds that are being issued for a social purpose or a social good on the back end. And we're seeing this, again, the push for environmental, the push, environmental ETFs, green ETFs, ESG ETFs, ETF funds, and anything ESG is just obviously getting a significant amount of capital pushed towards it, where you can see 2020, we're continuing to take out all-time highs in terms of US dollars that are being pushed towards the sustainable debt issuance, where obviously green bonds have been a much bigger thing, but not only just green loans, but a lot of the growth has been on the social bond side of the equation, which is just interesting to see how this is being pivoted and how individuals are taking advantage of it. But when we think of equity issuance as well, again, I don't claim to be an expert in everything or anything really. It's just when I look at Apple and you consider that it's $1 trillion market cap. I mean, maybe you know somebody who was underweight Apple. I don't know anybody that was underweight Apple. Everybody was overweight Apple. So everybody was overweight Apple, but yet there's always an incremental buyer, and the stock with $1 trillion market cap can go up 3% almost every day, and it moves like a penny stock. And it's a mixture of, well, do you have all of this money coming into the green market, and they're a green, pitched as a green company, but at the same time, we also have central banks that are buyers of equities and ETFs. And if you look at, because the thing is, who is the next incremental buyer? So when you buy a stock, you think the stock is going to go up in value, which means that somebody else will value the stock more than you value it, and it'll drive higher, and you have the next incremental buyer. Well, when everybody's already overweight and you start coming up against portfolio management restrictions in terms of concentration weightings and other types of movements, because as a stock appreciates, the concentration within the portfolio increases, and you typically have to sell some to make room for others. But if you're Switzerland or the S&B, or if you're Japan, well, you just print more dollars or more francs or more yen to just buy stocks. And that's something that we've seen where when you look at Apple, just not to pick on Apple only, but when you look at the top holders, a lot of them are central banks. And this is something that we're continuing to see. And you can see S&B, the Swiss National Bank, has accelerated their purchasing exponentially. Same with Japan. And it's just, you're looking at as a percent of nominal GDP. Obviously Switzerland is more shock value, but Japan is the third or fourth largest country in the world. So clearly that's a bigger component. But again, it goes to show who is the buyer, and it's going to be hard to say, well, when does that buying stop? Because at the end of the day, they really have an endless supply of dollars where they'll essentially sell their currency, trying to weaken it or maintain it, buy dollars and go buy stock. And that's something that we've continued to see, especially when you look at how much of this recent rally, or I should say the 2020 rally, has happened in the overnight hours, because these are it's Europe and Asia buying our stocks, and when no volume, the stocks just go through the roof, and then things through the U.S. trading hours just kind of go flat, and then they accelerate into the close, and then we see that new push to the upside. So again, very interesting dynamics at play here. And now with bank buybacks, this is something where when we're starting to see buybacks overall, when we look at the Fed talking about the health of the balance sheet, which again, with the fact that they've been selling so much into the Fed and increasing their liquidity, so sure, they have money for buybacks. So here's where you're seeing the average quarterly income, quarterly dividends, and room for buybacks. So they have expansions of what they're allowed to buy back in stock. Just to give you an idea of some of the things that could be drivers as we go forward, and some of the strengthening or views of liquidity that is sitting on the balance sheet within the U.S. So global GDP is expected to go from that contraction to expansion, and it's just important to appreciate where we're going to see the expansion. So as I've talked about, earlier, you can see that we went. The U.S. is expected to go down 4% and then go up 4%, and obviously they're not equally weighted. I just think that the 4% next year in the U.S. and especially in some other regions, obviously the Eurozone is going to struggle a bit more, and China loves to kind of fudge those 2019 numbers to make 2020 look better, and obviously make 2021 look just as good. These are things that I think are going to have to get reweighted, as we've already started to see some of these adjustments into Q4, and if that's going to carry out through Q1, because we're just not going to all of a sudden say, it's January 2nd. I feel good. Let's go party. It's like there's going to be a consumer behavior shift. There's going to be a monetary shift. There has to be some adjustments, and it's just not going to snap back. And that's why when we look at some of the breakdowns of U.S. consumer spending, you can see that it just isn't there on the service level. People are doing less. Total consumer spending has actually shifted to the downside. And just looking at some of the components where personal income was expected to be at 0.3% in November, down 0.3%, it was down 1.1%. Personal spending was supposed to be down 0.2%. It was down 0.4%. Real personal spending was supposed to be down 0.3%. It was actually down 0.4%. So again, this is clearly there's stimulus coming, but this is November into December, and we're just seeing, you can see the total consumer spending starting to roll over, accelerating to the downside, and just based on the movements as unemployment got worse, people got concerned, and again, December is going to be that continuation, and it's going to be hard to see January be the snapback, and that's why we remain cautious on that Q1, Q2 estimates, which will weigh down just general 2021 growth. And this is just looking at the shift in unemployment benefits. So here's what I was talking about earlier in the EIA show and then in the econ. So we had an increase here in November to increased 11%, then down, but the big spikes were 36%, 2%. So even though things were better than expected in this recent filing, where initial jobless claims were expected to be 880,000, they came in at 803. So they were supposed to be better than 5,000 better than last week. Instead, last week was revised higher. Initial jobless claims surprised for the better, but again, even though it's surprised to the downside, we're still not back to January, November numbers, which again gives us that pause of what does December look like, and then what does January look like as we go forward. And this highlights why the pandemic unemployment assistance, pandemic emergency unemployment compensation was so important in the stimulus bill. You can see the amount of people are continuing to go up. Even though this went down, we saw a shift up in the amount of people on these programs, which was supposed to expire in 3 days. Now it expires mid-March, and this is why, because these individuals need this money. So the extension, but again, you're extending what was already there. So personal spending is still going to slow. You're still seeing personal income decline even with this in place. So just because you're bridging the gap doesn't mean you're going to get another spike. The spike should come from the $600, and the question is it going to be $600 or $2,000 depending on what the agreements are. Again, these are the issues that continue to be an overall problem, with headlines coming across where Pelosi's bid for $2,000 checks will fail. McCarthy tells the GOP. Again, these are things that are going to be an inherent problem through the remainder, not only of this year, but into next year. So, but how are people positioned? Investment asset classes by size, and you're seeing that shift into the real estate and looking at commercial and residential as people want to try to find things that are hard assets that have some sort of cash yield, whether that be rental properties or something else, to try to protect against the inflation that is expected to continue to come. And who doesn't want 30-year locked in 2% cash? I mean, that's fantastic. And so you'd be crazy not to. And again, that's pushing people and really kind of pushing those prices higher on the real estate side. So, but what does it mean for money overall? Because I think that is the bigger issue at this point. And here you can see Americans are sitting on a large pile of cash. Households' checkable deposits and currencies continue to shift higher, and the savings rate and disposable income, though, is coming down. Personal spending growth is flatlining. So you're getting more money in savings. So you're seeing the acceleration of money in the checking account, savings account. So the idea is this money will be dispersed and will be unlocked as things get better, as COVID dwindles as a risk, as people get vaccinated. Money is stored up that can then be pushed into the market. Well, let's look at who has that money and how quickly can that get into the market. So when we look at it on an excess household savings in the U.S., excess household savings % of 2019 GDP is almost 6%, 6.5% in the U.S., And across Europe, if you're looking at it in different locations, the UK has some of the highest, but who has the money in the US? So let's take the US first. We'll cover Europe at later on in the program. So when we look at, first income quartile. So first income quartile is the lowest. So when we look at the breakdowns, and I don't know if you can see that lower side, household in quartile 1 earn between $12,000 and $30,000 in labor income. Quartile 2, 30 to 45. 3 earned 45 to 69, and 4 earned more than 69,000. So the first income quartile saw the biggest increase in checking account balances. So savings went up the most for the poorest. And you saw that happen throughout the different components. And why is that? Well, let's understand how it was disseminated. Some people or more people in the fourth and even third income didn't get the full allotment of cash. So there's less money that you're getting from a distribution from the government to put into savings. And so then you had people who on the poor level that got the full distribution. The problem is the pace of the drawdown is the highest amongst who had the biggest increase in checking savings account expansion. And this is why, even though the numbers look good, you're seeing an acceleration of money coming out of the system already just to fill the gap. And now, given we're still above where we were, and the $600 will be a benefit, but the first and second income quartile are spending more and more on food, on childcare, and that isn't going to change even with some backstops, which is why the pace and the pace is just accelerated, and that's why the numbers are a bit inflated in terms of what is available to then get pushed into the market as consumer spending, because those who have the biggest amount, making that percentage number look great, is already drawing down aggressively into year end. And this is just an example of how. Are you spending more money on childcare and education? Well, under 50,000, the first quartile and parts of the second quartile, 50% are saying yes. So again, you got more, you're spending more. So you're accelerating, and that's why we're seeing that pressure to the downside. And even people at the higher level are paying more for childcare and education, which again is creating some of this drawback in terms of, you're giving people money and it's immediately going, into places that, again, these are just expenses that in inflation that is just being discounted based on the weightings that it is, where this is inflation. Like, you're spending more, not because you want to, but because you have no choice to. And the companies are just, the prices are going up because you have less kids, so spreading the costs around less people. And there's just the actions they have to take in terms of PPE, other types of precautions just are inherently costing more. Which, when you look at the economic outlook, the question is going to be, base case scenario, we should start to normalize towards the middle of 2022, towards 2021, delayed vaccination. So it's always going to be a matter of, how quickly can we get the vaccine? What do the logistics look like? And this is why, even though we're expecting to see some sort of growth, it's just, what does that growth look like? And that's why we see that flatlining, and why we think there's going to be a continued kind of slowdown. And instead of seeing this big, steady rally through pre-pandemic levels, we think that it will eventually get there. I mean, obviously that's not a question. It's just a matter of when is that crossover point. And I just think it's going to continue to be under pressure as income growth, is dwarfed by those rising wage costs. Rising costs, again, wages are up 10%, which is actually going down if you think about real wages, while healthcare costs are up 55%, college and education 57%, housing costs 31%. And this is just some. We've talked about food, we've talked about everything. Again, this is, I'm running out of ways to say it, but yet, obviously the market continues to go higher. So at some point it'll matter. I just know that this is going to be a big gravity overhang that is going to pressure the market in general. And then this is where we're looking at continuing unemployment and this gap between, weekly unemployment, and the continuing unemployment gains where they're coming lower, but people are going from weekly again to that continuing claims. And we're just seeing this stickiness of people just remaining on the sidelines. And what does that cost? And here's the US, the billions. We're talking about $25 billion going out to these individuals, and it's just to maintain just stable growth and stable activity. And again, these are things that are just an overarching problem, which is residing in small business employment. Again, this is continuing to fall. As we talked about, we never got to the Thanksgiving highs, and we're continuing to shift lower. Now we're back almost down to July 4th levels. And it's just as small business employment is falling, that's just less wages, less money to spend, personal spending. This is less places to shop, less tax revenue. Again, all of these things point to a bigger overhang in expectations going forward versus what's currently out there, which is why when we look at high frequency data, the U.S. is again coming lower with Europe, and China is shifting higher, and we're getting this alligator mouth that's opening wide. But the problem is, we're the biggest trade partners with China. So if we're not buying, if Europe's not buying, that's where you're going to continue to see this drawback, which again is going to act as that anchor as these things continue to get worse. You can see Europe rolling over hard from September, US never really reaching those levels and just immediately starting to roll back over, pulling back down as we talk about in our high frequency data points. And again, these are things that continue to give us problems, continue to give us a concerning outlook across oil demand, economic growth, refined product demand that is really kind of being ignored in the market, or at least paved over with liquidity, but that can only last for so long until we need to start seeing the real economy start to pick up and make headwinds as problems continue to materialize through the remainder of the year.